Today, I'm here to talk about the elections. Pretty exciting time. A lot of really interesting things going on in the vol markets, pre-election and post-election. Here to speak with me today are Noel Smith of Convex Asset Management, as well as Ed Tom of the Cboe. Thanks for joining me.
Hey, John. Good to be here.
So, Ed, I want to lead off with you. You're kind of known for having all the Cboe's data kind of in the back of your pocket. Would love to get a sense of what you're seeing in terms of pricing right now for the election, for the event itself, for afterwards, and some of the interesting things you're seeing relative to years past.
Yeah. So at this point, we certainly are seeing an additional risk premium for the elections. But I think what's more interesting is that usually that risk premium dissipates the day after the elections. And we're not seeing that this year. So for this year, we're seeing that risk premium persist for about 2 weeks after the elections.
That's interesting. I wonder how much that has to do with, recent memory, right? And all the contested elections we've seen.
Well, that's exactly right. So I think that what that extra risk premium is the concern that the elections might be contested. So we've done some analysis as to whether if the elections were to be contested, whether or not that's a sufficient length of time to build in to resolve the contested election.
What have you seen in terms of what the correct time probably should be? What happened in years past? Give us a sense.
So we have two major points with respect to the U.S. elections. The most recent data point is Gore versus Bush, and that took about 5 weeks to resolve. And about 100 years ago, Rutherford Hayes versus Tilden, that took 5 months to resolve. So what I'm thinking is that, the right answer might lie somewhere in between. There's a possibility that that risk premium of 2 weeks might be a little too short to resolve the contested election.
God, I hope it's not 5 months.
Yeah.
If so, we'll be back in 3-4 months to talk to you. Noel, what about you? What are you seeing that's interesting? I know you trade these markets. So what are you seeing in terms of skew? Interesting different kind of details that you might be seeing along the surface?
I think the most interesting trade that I've seen is the not decay of the VIX futures premium really for the last several months. I can be specific because we put these trades on. We bought the NOV 30-40 VIX call spread for between 52 and 45 cents. In other words, we paid 45 to 52 cents for the 30-40 call spread, and it's still the same price. It's 46 cents. Exactly. We did that at the beginning of the summertime. And the thesis behind that was, it wasn't so much that Trump would win or Kamala would win, because this is a unique situation where we both kind of know with either president or with either candidate what we're getting. So I thought that the actual resolution wouldn't be a vol-on event. I thought that the lack of a resolution would be a vol-on event. So we elected to hedge in November VIX as opposed to October VIX, because October was high already, and VIX in November was just more reasonable. And if you call it rounded to 50 cents for a $10 wide call spread, that's pretty good value. So that's something that's been working for quite some time. And if you go out to December, as of this morning, I think that same call spread is like 26 cents. And the January call spread is also pretty modestly priced. So there's an opportunity there that if you think there's going to be a contested election and it drags through that expiry, 26 cents for a $10 wide call spread isn't so bad.
It's particularly interesting as it relates to that. We're going to nerd out a little bit on some of this stuff, but is how much the August kind of wobble, the thing we saw, right? The risk off we saw in early August kind of played a role in some of that. Also, December being a quarterly option, right? And the open interest that already existed back there, right? Because it's been a leap and it's been on the sheets for some time. There was that potential energy for that skew to go higher and that vol to continue to broadly perform based on some of those factors. But what we haven't seen is we saw that spike in August and a lot of that vol back there, and particularly the skew, but it hasn't come back down, right? And that's the really interesting part, right? The vol came back down. I think Tom, Ed, you spoke about this a bit at your speech, but really how elevated it's remained even as we approach it, right? I think that's particularly interesting. Any numbers behind that or anything that you're seeing?
Yeah. So basically, numbers wise, I think it's best to express it in percentile terms, right? So, prior to August 5th, skew was trading slightly elevated, around 74th percentile, and post August 5th, it jumped up to about 90th percentile. It remains high 90th percentile to this day. So I would say that yes, skew definitely is elevated at this point.
Yeah. And 90th percentile, mind you, on what's an already elevated vol. And I think that's important. Some of these out of the money puts are trading astronomical, right? And to Noel's point, it's an environment to do put spreads or call spreads in the VIX because of that skew dynamic. So given all of that, what do you think, Noel? You mentioned the call spreads you bought, but at this very moment, do you see those as the best hedges or the best way to kind of play this? Are you more of a vol seller going into this event or a vol buyer? Give me a sense of what do you think the highest probability bets might be out there. And for the sake of this, let's go beyond VIX and SPX even. I mean, we can start there, but are there any interesting plays outside of that complex?
So it's a broad question with, we could talk about that for quite some time, but sticking with the theme of VIX and or SPX for the first part, that specific call spread that we bought for, call it 50 cents, it went up to almost $3 in August. So we actually sold it and then we rebought it back down into the previous price, which was pretty neat. But regarding how to hedge the event and exactly what you were just talking about, which is both of you guys, with the skew being up so high, you would say that a lot of those hedges on the left tail, which is to say market go down, is also hedged already. And if the skew is high, that means the vol is high. And if the vol is high and the vol comes down, the delta of those options is going to change, as you like to talk about the VANA. So as the hedging function on that changes, you can get a rip into the end of the year. And so I think that the more likely outcome is up into the year, end of the year after the election, as that vol comes in, once the unknowns become known, volatility compresses, specifically on the wings, the VANA effects start to change, and then the hedging function of that starts to increase because the delta on those options are changing, even if the price doesn't change. And then you also have the time function, which of course we also talked about. So there are several reasons that market goes up. And then the reason the market goes down is maybe a contested election, there's some kind of violence or whatever else. And I still think that expressing it in VIX terms is cleaner because it is not location specific in the gamma land. So if say you're at 58.50 in the SPX, if we move 100 points one way or the other, your options could would have to be restruck somewhere else. But in VIX land, you can still do that in say a 25 call or a 30 call or whatever else. So I think that's a superior hedge.
No, you're speaking my language, obviously. I think a big part of options positioning that people don't think nearly enough about are the reflexive effects, right? It's easy to look at at first blush and say, okay, this vol is high or this vol is low, or on a relative value, this option might be cheap or expensive. But when you start to think about the positioning and the actual reflexive effects it have, these VANA and charm flows, for example, the gamma effects, you really begin to get a different picture, right? And I think the interesting thing about when you look at an event vol, a big one like the election in particular, is that overwhelmingly, these are sell the news events, right? The vol gets priced high because people are hedging, because people are concerned. And in the normal world and on Wall Street, they'll call this the wall of worry, right? But this is the actual effect that underpins a wall of worry. A worry means people need to hedge. They're scared. They're buying puts out there. But what that means is that dealers are short those puts and they're short stock. And now the price has gone up so much that the move that's necessary, right, for this to actually come to fruition is massive. Exactly. And if that doesn't happen, now it can happen, that tail is big, it's real. But if it doesn't happen, which it becomes highly probable, and there's a massive flow of delta buyback that needs to happen. In the 2 weeks around the election, you and Sinclair talked about this in his panel. Historically, there's a 27% annualized positive bias to the market. Annualized, but that's a big number, right? Now, some of that is baked in from normal data. There's generally, I guess, close to a 20%, even if there's not an election, to be clear. But the point here is during that part of the year, there's also positive flows and there's an event ball that creates an extra positive push. There's a reason that regardless of who's elected, right, we've seen that kind of positive push, despite all the fear that we've seen going into these elections. Do you have any other thoughts about kind of those predictive elements and how those might play out? Yeah, Ed, why don't you jump in?
I totally agree with Noel. So basically what we're seeing on the volatility side is basically like increased convexity with respect to the skew. And what that means is that volatility traders are playing for like a large move either to the upside and the downside, and they're funding that by selling the at-the-money vols. So basically that causes the skew to basically like bow out.
Yeah, I noticed that actually. You were talking about how call skew and essentially what we call kurtosis, right, is actually quite high. It's not just the put wing, right? And I think that's particularly interesting too.
Yeah. So I think the translation is that traders are not betting for the markets to remain where they are currently. They're betting playing for either a large move to the upside or the downside.
And I think some of that might be this increased sophistication and people realizing that a lot of times these things do actually, when it's high skew, turn out to be big moves to the upside. I'll highlight a couple of other effects. I'd love to pull you in on this, Noel, and get your opinions. But this isn't just an election coming up. It's a seasonally positive period. And there are lots of things that underpin that, right? I think that's part of what I mentioned drove the excess skew in DEES, right? And why that's also a positive bet and was an interesting bet early on. But some of these effects are just simply the open interest that exists, given that DEES options are on the board for years as leaps. Structured product issuance is very focused on the end of the year for not only index, but single list. And then on top of that, it's a very historically, time filled with holidays and time off. And that actually accelerates time, accelerates VANA compression once these events are passed and people are feeling a little bit better. Love to hear your thoughts about some of those effects and how those might be playing into what we're seeing.
It's just math. I mean, there's less days, and there's less days that people are going to be around. So there is, generally speaking, less activity. So if you think about a normal distribution curve, and then you're saying that the shape of the curve is lifted on the wings, but as that goes down, it's going to come down at a rate of change different than the meat. So what that means is that as that differential starts to kick in, those wings and people that are buying these wings, a lot of times I think that the call buyers are for people that have underperformed the marketplace and they have to catch up, and they may not want to do that in the Delta One instruments, so they're going for the options. They're going for the out-of-the-money calls. But if they're disappointed, what's going to end up happening is vol is going to get even more crushed. And so, ironically, I think that the Delta One instrument might be a superior play to that.
Yeah. In the other interesting part is, these VANA flows, as we mentioned, are tied to not just open interest in the amount that dealers have on, but how high it's priced, right? Because the higher skew is priced, the more room it has to come down, the more delta that the dealers have to buy back really well during this period. So this is an incredibly positive seasonal period. And that's what underpins seasonality in this period, by the way. I mean, pretty amazing, but the last 2 weeks of the year and the first 2 weeks of the year, which we often call the Santa Claus effect or the January effect, that month outperforms every other 4-week rolling period by a dramatic amount historically, but particularly when the market's up. And so I think that's really interesting this year. It's always a positive seasonal period, but I think particularly given some of the dynamics we're talking about, it has a very high probability of being positive this year. We'll see. The last point I'll make is in a big up year, there is a reinvestment effect that happens at the end of the year, beginning of the year. That's a function of releveraging of portfolios. At the end of the day, if you have a $50 trillion U.S. market, 200 trillion of assets tied to it, market's up 20%. That's anywhere from 10 to $50 trillion of new collateral. And so that gets reinvested at various periods throughout the year, but particularly at the first of the year with slower moving things. So that's also a thing that people are realizing. And then, of course, at some point you have these things pushing. Everybody now is in a chase, right? And now you get cascades. And I think that's something that's critical. All right, let's pivot a little bit. Let's talk not just about broad markets, but Kamala versus Trump, right? What do different outcomes potentially mean for markets? What are we seeing in terms of pricing and changes? Ed, I know you spoke a little bit about this. I'd love to hear some of your thoughts and what you see happening.
Yeah, I would say this, well, with respect to, say, the broad markets, and when I say broad markets, I generally mean the S&P 500, right? So with respect to the S&P 500, there are really only three sectors that really matter. Technology, financials, and healthcare. And purely because, they have a much higher weighting with respect to the S&P than the other sectors. And finally, I think the fourth sector that kind of matters is energy, mainly because it's scalable. Scalable as a trade. So if we're kind of walk through the comparisons of Trump versus Harris across those four sectors, I would say that generally there's not a huge difference in policy between the two candidates. So technology, it looks like option traders are pricing in a slight favorability for Harris, mainly because they believe that Trump's war, basically tariffs, will negatively affect semiconductors. With respect to financials, Trump has a slight, favorite bias, and mainly because the thought is that he's going to push through some regulations that will basically smooth out the process for regulatory approvals for M&A activities. And healthcare, it's split. So Trump has an advantage with respect to big pharma versus Harris, which has an advantage with respect to healthcare providers. And finally, energy. Trump has a clear advantage. So the vast majority of the constituents within the S&P are biased mainly toward fossil fuel producers. So Trump's policies of potential deregulation with respect to that favors him over Harris. She has a little niche within energy, which is she has an advantage with respect to alternative energies.
Very interesting. I think one of the so John Harwood was actually the keynote speaker here at RMC, and he made some very interesting points, some things that we've been kind of diving into ourselves, but that and I think they're particularly relevant as it relates to convexity and options. The idea is that if Trump wins, the probabilities of him winning the Senate and the House are very high. That's if you go by a state by state or area by area look, it becomes clear that that's the case based on who's up for election. We won't dive into the details, but and if Kamala wins, the odds of her winning a full sweep is very low. And what that tends to mean is it's not really about as much who wins in terms of the presidency, because if Kamala wins, essentially we're more likely to get status quo. So the bets aren't necessarily to bet on what might happen if Kamala gets elected. It's to hedge or to bet on the convexity of things getting pushed through if Trump gets elected. On top of that, I think you can argue the Trump versus U.S. Supreme Court decision gives the executive branch a bit more power. It's Trump's second time around. He's more likely to be better prepared to push things through. So I think there's a real case that even if it's 50-50, the risk or the hedge, the thing that you should be looking at are the outsized potential moves on a Trump election. Noel, I'd love to hear your thoughts on that, and if there's anything that you're looking at as it relates.
Ed gave a very well-considered and thought-through answer. It's hard to disagree with any of it. Just listening to him, I guess I would say that while he accurately stated the pro rata allocations within the S&P 500, I was looking at more what are the differences and what will change. And my focus was on energy. Even though energy isn't as large a portion of the index relative to technology, I think that the move in energy would be larger than its current pro rata allocation. So with that, if you look at things that are benefited or decremented by either candidate, it kind of goes both ways. It's kind of a quadrant, right? You have red good, red bad, blue good, blue bad. And if you go through that, you're looking at the mean volatility that I've seen so far, or increase in volatility, are things that would be hurt by tariffs and energy. There are other categories, but they are not as significant so as to make it all that tradable. So you can say things like, discretionary or whatever else. But again, there's not really any mathematical reason to really focus on it. And, we talked about dispersion yesterday. And if you're thinking about, you have a group of names all doing one thing at one time. And then if there is a new outcome with new legislation that could be enacted, they do kind of find their new homes in their respective camps. So I think there are trades there specifically within correlation and dispersion trading, because now we have a kind of a new sheriff in town, no matter what. And then that everything will go to its new place where it finds the most favorable treatment.
Yeah, I think one of the more interesting things that I'm looking at are, and I think the market's starting to price it a little bit. We've been talking about it for a little while. Is the structural inflationary effects, right? If you look at tariffs, if you look at the immigration policy, right? Part of what's been holding inflation at bay from a structural perspective is the open immigration policy by the Biden administration. People don't talk much about that. I hear a lot of negative press about it, but that's actually what's keeping down labor inflation, even despite how strong it's been. I would argue that if you get tariffs and we're closing borders from an immigration perspective, that's very structurally inflationary. We've seen that historically, something that we saw in the 70s as well. Never mind kind of global conflict and things that come along with that, which are also structurally inflationary. So I think something that looks like a curve steepener, and then from the equity perspective, anything that gets hurt during inflationary periods, I think would be a really interesting play right now versus kind of, energy would be a great place. Gold, which has been something we've been talking about for some time as well. All right, to close this off, we've talked about kind of the election and where we stand now. Some brief kind of looks into the future. I mentioned inflation. Let's contemplate because we think the Trump victory is more convex. Under that scenario, other plays that you see as particularly interesting in the years to come, this is a 4-year period, right, that we're going into. It's not just what happens this week, this month. There could be some real big secular trades to play. You mentioned gold, Noel. I'll let you lead off. Anything else that's on your mind?
I mean, the things that you previously just discussed, which is inflationary things. To me, that's the most obvious thing. So we do have on a steepener, which is to say the steepening between the 2s and the 10s in the 10-year and in the yield curve for defining it. And I think that is a trade we have it on. So clearly, I think it's a good one. And I think about the things that are disinflationary and the things that are inflationary, and I almost always move to the inflationary camp. If you think about cheap labor coming into the country as being disinflationary, but then the spending that goes on a pro rata basis with it to accommodate these new people, that can be inflationary. And I don't know where exactly that pencils out, but there are, yin yang forces on that. We look at reshoring as being inflationary. We look at tariffs, inflationary. And, at some point, especially if Donald Trump wins and he either hammers Powell or there's a new Fed chairman, the idea that rates would be lower and the economy would be run hot, I think is a fair play. Frankly, I think that both candidates will run the economy hot. Trump more so. I think he would use interest rates as more of a weapon to get what he wants. And the idea that, a sandwich costs $20 these days, I don't think that's going to reverse.
Yeah, I mean, if we get extension of taxes, particularly corporate taxes, that's going to be very hot in terms of cyclical inflation as well. And to your point, Trump's talked a lot about pulling the Fed in a little closer, right? And I think that would probably be his goal. So yeah, seems very hot and inflationary to that end. Calls just in the S&P. Love to hear any other thoughts you have as we close up. Ed?
No, I think that we pretty much covered like a lot of ground here. So I think we're good.
All right. Well, thank you guys for joining me. Wonderful conversation, and look forward to doing it again. Hopefully not in 4 months when we're still at a disputed election. Thanks, guys.
Thank you.
Thanks.